Capital gains tax explained.
You're listening to Home Sellers Advantage. I'm your host, Aaron Zapata.
And I'm your other host, Todd Anderson. We are the Bald Brothers team at Impact Realty Group with Real Broker, and we are here to give you the Home Sellers Advantage.
You can find us online at www.baldbrothers.tv. Again, that's baldbrothers.tv.
Or you can call us at 833-305-BALD. That's 833-305-2253.
Okay, so you're tuning in today because you bought a home years and years ago. Maybe it was only 5 years ago. And it's appreciated over time. And you want to know, how much am I going to pay in taxes due to the capital gains? Mm-hmm. Now, what is a capital gain, Todd? Now, first of all, before we go into this, we're not CPAs.
Yeah.
Okay. We're not your accountant. We're not your financial advisor. But we are going to share with you some of the basics, and you can confirm all of this with your professional on how this works. And this was inspired by a phone call that I had with a client this morning regarding how much taxes need to be paid from his sale of his home that he did last year.
Little bit of confusion. And I realized when you were describing that conversation to me how it can be confusing. And so, basically capital gains, most of you, if you're not aware of it in simple fashion, capital gains is taxes that you pay based off of investment earnings. And so you've got short-term capital gains, long-term capital gains. But when it comes to selling your home, if you purchase the home for
$200,000.
Okay, I was going to say five. Yeah, but let's say $200,000, and you sold it for, what do you want to sell it for? $1 million. $1 million. $1 million. That's a gain of $800,000. You at home, did I do the math right?
Yes.
$800,000, but that's based off of the gain. Now, there's other things that factor in terms of any upgrades to the home and that sort of thing, but just keep it real simple. Keep it real simple. You would have to then theoretically pay taxes on $800,000 of income based off that investment earning.
And it's a gain.
It's a gain that you've gotten. Now, there's some advantages to selling a home that gives you a tax break. And we'll talk about that, but this is where some of the confusion lies.
Yes. Now, we're not talking about Chip and Joanna gains.
No.
Okay, good. We're just talking about capital gains. And so when you sell that house...
They should have a son named Capital.
They should. That would be so funny. Yes. So when you sell that home, right, you sell the home for $1 million. And let's just do some simple math.
Yeah.
Let's say that, for simplicity, it costs $100,000 to sell the home between commissions and escrow fees and title fees and credits to the buyer for repairs or whatever it costs. It's $100,000. Now we're at $900,000 minus the original $200,000 purchase price. And now you're at a $700,000 gain. Mm-hmm. Say, keep it simple. Now, according to current taxes, the law, IRS, whatever, they say that a single person has a $250,000 exemption, mm-hmm. and a married couple has a $500,000 exemption. Yeah. Now, keep in mind, these numbers were set in place in 2000.
Yeah.
They're over 25 years old now.
So it's not even taking into consideration today's market.
So there is, there have been proposals I've seen from the White House where they're saying, hey, we're going to eliminate capital gains altogether on real estate. Mm-hmm. So if that happens, you can just delete this right now because it's no good. Yeah. Which would be really amazing.
It can be a throwback episode, and you can show it to your friends. Remember?
Yeah, remember when? Now, because this
could you imagine if that actually happened?
Even if they updated it to current income limits and housing prices, let's say $500,000 per individual and $1 million, right?
Oh, yeah.
That would be amazing. Because every conversation we have with sellers right now, if they have owned this home for more than 15 to 20 years, they're asking about this question. So let's just go into some of the details.
Let's go back to the example. Let's say it's a married couple. So what Aaron just said is if you're single, you get a $250,000 tax break. If you're married, it's $500,000. The reason I said married is because it's real easy math. So right now you're at $700,000 in our hypothetical situation of a gain of $700,000. Now you subtract, because you're a married couple selling the home, subtract $500,000, and drum roll, what does that leave you with?
$200,000.
$200,000. So let's review. You originally bought the house for $200,000. You sold it for $1 million. And now, and we talked about marketing costs and all that, you sold it for $1 million. Now your capital gains are not $800,000. Now we've reduced it to $200,000.
Right, because of closing costs and selling process, and then the actual minus the exemption is your $200,000. So when you go to see your accountant at the end of that tax year in the house in the year in which you sold the property, you're going to recognize $200,000 in income through capital gains income.
So in this scenario, you still will have to pay taxes on the sale of your home, but it's going to be mitigated based off of that tax break.
Right.
So you're still going to pay taxes. You're going to pay taxes on $200,000, not $800,000. And this is where the confusion came in this morning with that conversation that you had.
Because the conversation stemmed from a client who sold a house, had a capital gain on the home, and he was talking to his banker buddy, and his banker buddy says, "You're exempt from $250,000 in taxes."
Yeah.
Okay. Now I'm going to say that again. You're exempt from $250,000 in taxes.
Yeah.
So he was calling me saying, "Hey, I have a tax bill for $24,000. I thought I was exempt from $250,000 in taxes."
Yeah.
So I said, "Well, no. That's looking at it improperly." So what the confusion was is that he thought, "Oh, well, I heard," and is a single person selling a house, so that's why the $250,000. Okay, he thought that if he owed up to $250,000 in taxes, it would be wiped away.
Yeah.
And I said, no, that's not.
That's
how
where
it
the
works.
confusion was.
Yeah, your taxes don't get wiped away. What happens is it gets deducted from the gain of the property. And so it was like a light bulb moment for him. He's like, "Oh, okay, that's why I owe the $24,000 in capital gains." And I didn't go through the whole math with him to like explain that, had he not had the $250,000 exemption, he would have paid an additional $13,000 to $17,000, whatever it was, like another $38,000, I think, depending on capital and state and federal. But he was like, "Oh, okay, I get it." And the other thing too is this is an IRS exemption. Your state may not give you an exemption for capital gains taxes.
Yeah, depends
so
on
this is definitely
state.
with the federal level. Okay, so that's why the confusion came in.
Yeah. Now, there are, to add confusion, and that's
You're
not
gonna
my
have more
intent,
confusion?
but there are some other things. Aaron mentioned that, of course, the cost of selling the home, that would be included. There's other things that you can include. Now, once again, as was said at the beginning, we are not tax professionals, so everything that I'm saying, you need to check with your own CPA, tax professional. You should not be getting tax advice from your realtor.
Or ChatGPT.
Or ChatGPT. This is a PSA, so to speak. But for actual advice, you need to speak with your tax professional. But what I will say is that if you have done upgrades to the home, you've done an expansion, an addition to the home, all those sorts of things should be able to be added to your cost basis of what you've actually put into the home. So let's say that
now
you
the cost basis is the purchase price, initial.
Yes, your purchase price would be $200,000. Now, in selling the home, in this theoretical scenario, it was an additional $100,000. So now it's
no, let's do 200.
Okay,
makes it easy.
Okay, so now
$200,000 in upgrades.
Okay. Oh, in upgrades. Okay, yeah, that makes it easy. So now you're $400,000 plus the $100,000 to sell the home. So now it's $500,000. And you sold the house for $1 million, and you get a $500,000 tax break. Guess what? You owe $0 in capital gains. And so there's a lot of extra things beyond just the purchase price of the home and the cost to sell your home that can be factored in when it comes to filing your taxes. But once again, check with your CPA, check with your tax professional. But these are all things that you should go into it with at least a cursory knowledge or understanding of what that is. So when it comes tax season, you realize there may or may not be a tax bill. We don't want you to be surprised and taken off guard.
Now, there's one other thing that homeowners really have a hard time grasping in the past when we talk to them, and that is when they refinance and pull cash out. So let's just go back to our example, okay? You bought it for $200,000, and over the years, you did a cash out refinance and you went and bought a boat, or maybe you bought another property, or maybe you just needed it to pay off credit cards. And your loan at the time of sale is $500,000. Okay, your loan at the time of sale has gone up from $200,000 to $500,000. So now you owe $500,000 on $1 million property, and you sell it for $1 million. Your closing costs are $100,000, and you only net $400,000 from the sale because you got to pay off that $500,000 loan. Mm-hmm. And so you're sitting there on $400,000 net profit from the home. And then the IRS comes and says, hey, you owe taxes. Well, you're going to say, well, I only netted 400, but I'm exempt 500. Mm-hmm. Why am I owing taxes? Because here's the deal. Your loan balance on the property has nothing to do with capital gains.
Yeah.
And so just because you didn't walk away with the more money doesn't mean you didn't have a gain. Mm-hmm. They look at your initial purchase price plus your cost of upgrades that were done in recent years to prepare a home for sale or upgrades, minus closing costs, and then you have your $500,000 exemption. Mm-hmm. So it's quite possible in our scenario here, you walked away with $400,000. But what if you borrowed $800,000? Mm-hmm. Okay, and you owe $800,000, and you sell your $1 million house, you have $100,000 in closing costs, and then you pay off this $800,000 note, you walk away with $100,000. Now, the IRS, all they're going to see is $1 million minus the 100 minus the $500,000 exemption, which is now $600, and you're still going to have a capital gain of $200,000.
Yeah. You're
going to have to pay taxes on that. And you're going to be like, why am I paying taxes on $200,000? I only walked away with $100,000. Again, the IRS doesn't care what you borrowed against your house. Mm-hmm. They only care what you bought it for and what you sell it for, and the costs in between.
Yeah.
So there is confusion. Hopefully that clears up some items.
There is confusion, and we just confused you even more.
Oh, I don't think we did.
No.
I think we gave them
attention to
good information.
There's what he's saying is there's just a lot of extra things that can work into the scenario, but when you break it down to brass tacks, it's the original example that we gave is the simplest way to realize it, and the difference between the tax break and the actual taxes that you pay.
Now, I'm going to add one more scenario because it's a very real scenario for a lot of our clients, and that is if one of the two owners that own the property passes away. Mm-hmm. And then you have what's called a stepped-up basis, and that means the house gets reevaluated at the time of death, and then capital gains gets readjusted according to a number of parameters, of which this show is not going to cover.
No.
That is a question for your CPA.
Yeah.
But I will say this. We often do what are called date of death, CMA, property valuations, and that's basically like an appraisal based on a specific date that a person died to reevaluate the value of the house at that date, and that information goes to the CPA, gets calculated on how all of the taxes get calculated. So there are different caveats like that make it confusing, but we wanted to bring you the most basic and hopefully provide an understanding that when you say you get a $500,000 tax exemption from capital gains, it doesn't mean you get a credit against your taxes that are due up to $500,000.
Yeah, there's a big difference between a tax credit and a tax exemption.
Yes.
Yeah, and that's where the confusion was.
That's right. So hopefully this made it as clear as mud. No. Hey, guess what we do?
We sell homes?
Yes, we do. And if you're in Southern California and you're thinking about selling a home, if you're talking about getting top price, go back and listen to the last episode because we talk about 3 strategies to use on how to get top price. But if you're just thinking about getting the wheel started on here on the thought of selling, we'd love to talk to you in person. If you call our 800 number at 833-305-2253, that does go to an answering service, but that gets forwarded directly to Todd and myself, and one of us give you a call back and set up a time to talk about your process, your capital gains, your situation, so that we can walk you through selling. Until next time.
Toodaloo.
Toodaloo. Like, subscribe, and share. Love y'all. Talk to you soon. Thanks for listening to the Home Sellers Advantage. The Bald Brothers team is a licensed DBA of Real Broker, licensed by the California Department of Real Estate, number 02022-092. Again, we do not give any real estate, legal, or financial advice. If you'd like to reach out to us, you can call us at 833-305-BALD, or you can reach us online at baldbrothers.tv. Equal housing opportunity.